everyone, welcome to this edition of the Cashflow Chronicles Open Forum. Thank you so much for the support that has been growing. The amount of people interested in joining this has honestly been overwhelming. And happy to share the resources we have here with many experts like the individuals I have here today. You may see Scott Harris, the first guest ever, the banker extraordinaire. Then we have a friend of mine, Dennis, at Focus CFO, that has 35 years as an acting CEO and CFO. Of course, today's topic really is going to be focused on cash flow, and the biggest thing is forecasting, because I think everyone thinks cash is in the bank, we're in good shape, but ultimately there's some strategies that should be best practice, and I think both Scott and Dennis can speak to this. So, Dennis, I'll let you introduce yourself and anything to add to us.
All right. Thanks, Matt. Nice to be here with you and Scott. Appreciate it. And I can tell you, in our business, cash flow is kind of the biggest issue that we see when we're out looking for clients. And I think it's the biggest issue with all businesses, but particularly small businesses.
Yeah, definitely. And anything to add to that, Scott?
Well, as we talked about in our last session, Matt, and I think that you coined this so well, cash is king, right? And when we're evaluating the ability of a company to repay a loan, the number one thing aside from character that we look at is cash flow. And so I think it's really prudent, given what's going on in the economy today, to have this timely conversation with Dennis.
Absolutely. And of course, I'm the trade credit insurance guy here in Michigan, so I'm directly tied to income and cash flow. So this is really relevant for me to learn from these focused individuals. So, all right, Dennis, first question I have for you. So as a fractional CFO, you work in businesses after typically they've faced some challenges, or maybe they're thinking about looking at their financials. What's the first thing you look for when there's like a sign of trouble, when it's time for you to come on board and address challenges?
Well, generally, we're going to identify the issue even before we start working with them. Generally, people have issues and they have financial problems when they look for us, when they're kind of searching us out. More often than not, those are issues related to cash flow. And it's all about identifying cash flow problems that are going to arise in the future. So how do you do that? You do it with forecasting, you do it with budgeting. You look forward, knowing what's going to happen within your business. The people that we see have problems don't do that. They don't forecast, they don't budget, and those issues just come upon them. They're not aware of them, and so it creates a lot of anxiety and frustration for the business owner and the business itself.
Yeah, that is actually helpful. Do you ever have challenges that you come across, individuals, businesses think, hey, I'm doing great. People think, wait, I have no need for your services. Is that a pretty common obstacle at times?
It definitely happens. And I think because people don't look forward, you can have a successful business that's growing and doing well, but will run out of cash. And I don't care how well the business is doing, if you run out of cash, there's a lot of issues that you have to deal with. Making payroll, paying your accounts payable. But it can happen to both, growing successful businesses as well as those that aren't.
I can think of a major company that's $4 billion in operations. I posted on LinkedIn recently that just shuttered, has 8,000 customers, and it's a cash flow issue. So it's a very realistic standpoint. I'm sure you have some of these stories like that too, don't you, Scott?
Well, it's interesting, Matt. Dennis brings up a great point that it's not always operations aren't working well. Growth capital can be as challenging or as important of an issue as it is when operations aren't operating in the manner that you want them to. And so, for example, the couple you alluded to, right? They may not have had the money to pay their trades, to pay for inventory and infrastructure as a result of the growth that they were experiencing.
Yeah, I always like to think with growth comes risk. I think we can all agree. Who doesn't want to grow their business? But at the same time, your cash outlay to grow, there's risk to that because I think you can speak to that, can't you, quite a bit, as far as growing businesses?
Absolutely. So if the business is growing, almost always your investments precede the income that'll be driven by that, right? So it's additional people and it's additional inventory that you need to invest in before you get the actual growth, which is going to be a cash use or a drain on cash flow. And that's where businesses sometimes get into a tough place.
Yeah, which kind of drives me to my next question. So when a company comes into let's say a business survival issue, or they're tight on cash or something along those, what's the best practice you recommend in those scenarios where it's like, hey, we didn't make accurate forecasts to avoid them falling into like a failure circumstance? Is there any recommendations you could do? Like, let's say they're seeing their trajectory going a little bit worse than what they anticipated, or they have a proper plan. Is there like a recommendation you could do? Is it too late for you to come in, or?
No, I don't think so. As long as there's, financing that's available out there, it's just being able to see when that's going to be needed, getting out in front of it, and making sure that it's going to be available when the time comes and when you're going to need it. So that's the key. And if you're not doing forecasting and budgeting, you're not going to know when that is. And so that's the biggest, challenge of the business. And that's the biggest requirement when we get in there to put those in place. And a lot of times we'll go in, they don't have anything. So first thing we'll do is a 13-week cash flow forecast. That 13-week cash flow forecast lets us look out that far, which generally would give us time to put the financing that's needed in place.
Yeah, I think, and I'm sure Scott can speak of scenarios like that too, right? As a lender.
So Dennis made me think of a phrase that I constantly have told my customers over the couple decades that I've been doing this, which is, I never want to be in the position where I've lent you the last dollar that's available to you. So I think all of us know that there is a finite amount of capital that a company can qualify for. And if their operations are stressed and strained, in particular as an engagement is beginning with a firm like Dennis's, then he does have a limited window to identify what the issues are and then find a lender who's willing to step in and provide that capital.
And Scott, would you agree that if we have 3 months and we're providing the information you need to support a line or a loan, is that going to be sufficient time for you to put that in place for us?
I mean, most of the time, like a bank can receive, evaluate, and come up with a solution within that 3-month period of time. And of course, it's going to be conversational. There's going to be emails, communication going back and forth. It's not just going to be, you do your work and send it to us, right? And then we, take some time and respond back and it's over. It's going to be, hey, look, what if we did this? What if we consider that? Those are going to be the type of conversation that we have to derive a solution. And again, we're talking in a more distressed situation. For a situation that's not distressed, right, that runway is a lot longer, right? So it really is going to depend on the severity of the situation, how quickly everybody needs to act and respond.
It just that two things that resonated with me the most is there's so many times, because I'm in the world of AR, and non-payment comes into the factor. It affects your cash flow, of course. Either a company's in the situation where the banks send them to distressed assets, and it's like, hey, I need AR insurance for a loan from a bank standpoint. I need it in 2 weeks. And I'm like, I can do my best, but that's a short turnaround time frame. Or you have those businesses that really think ahead of time, as I've been stressing so many times, let's future-proof your business with one like lump sum of time. It doesn't take much time at all. So you're foreseeable with your certainty from a cash flow standpoint, much like you said, the 13-week forecast. So with that 13-week cash flow forecast, how does the process work if you're coming in to work with a new client? How does that process work typically?
So generally, we've talked to the client before getting in there, so we kind of understand the general operation of the business and the financials that exist today, because everything is based off of the historical financials. So, assuming a good foundation is in place there, then for us, it's just working with the ownership of the team to put the elements of the cash flow forecast that need to be in place. So what is the AR experience? What is the AP experience? What's the payroll cycle? And both the sources and uses that apply, that relate to each of those areas.
Okay. Can you think of any experience in your 35-year history as a leader where you've had some obstacles? I'm sure everyone learns from obstacles and things like that.
Sure. So, in a lot of cases, there are businesses out there, especially in the small business world that we primarily work in, that there's not even, historic financial statements to rely upon. There's no financial statements, or they're using the tax return as a financial statement, which, is inappropriate for that purpose, right? The tax return is a very different, use and need. And so, putting the foundational information in place upon which to build is probably the biggest issue that we see. If they've got good transaction systems and processes, meaning for AP, AR, and payroll, then it's a doable situation for us, and it's just a matter of getting the information from those systems and putting them into the forecast.
So Dennis, you just mentioned sources of and uses of cash a second ago. And that brought to light something like those are different levers that you can pull as you're trying to find cash, in particular in a very cash constrained situation. Can you talk a little bit more about those levers and how you would pull them in a distressed or challenging cash situation?
Sure. I'd say we'd start with the accounts receivable. And are there things we can do to accelerate the collection of the accounts receivable, right? Can we reach out to longtime customers that we know very well, that we might be in a position to kind of pay their receivable in advance of when it might normally be paid or normally be due. The next lever after that, and maybe before that, and it can be done simultaneously, is the accounts payable. What payments can we defer for what period of time, before we get into, pushback and issues from our vendors. We don't want to push on our vendors like that, but everybody gets in this situation, and sometimes you need to do that. And I think an open line of communication with those vendors kind of helps that situation, if you can let them know that the payment might be delayed, a week or 2 weeks versus when it would normally be paid. Payroll, I don't really like to get into that lever because that has a lot of different implications for the business. So that's kind of usually the last recourse that we'll use in that regard. But it's one that is ultimately available. It just comes with additional issues.
Yeah, payroll is never a fun thing to touch unless you have to, which I think we can relate in that scenario. I always like to think about that inflow of cash versus the outflow of cash. So how do you manage that appropriately? Because in one industry, let's say manufacturing right now, if they're decreasing margins, let's say, for example, and they can't pay their bills, then there's a supply chain effect because they're late to pay one person, and then their actual supplier is then late, and it trickles down all the way down. I think communication is the biggest factor for sure. And even having the flexibility from somebody like Scott to help offset those late payments, so you're not in a tight cash situation. If your AR is coming in late, someone like Scott can come in and be like, hey, we'll float you for a period of time, with due diligence, of course, to help facilitate those challenges.
To that point, Matt, like you bring up a great example, like another lever to turn the dial even farther on what Dennis said about AR. And I agree with you emphatically that that's the number one lever that you have most control over, is how do I bring money in faster? But on that AR that is still outstanding, bankers who are familiar with it can recommend to their clients and say, hey, look, you're kind of concentrated, right? We're only advancing 75% on your AR. If you considered and purchased trade credit insurance, we can dial that up to 85, maybe even 90% on, I'll call it blue chip names. And there you've created another use of cash that previously wasn't there. Now, that's not obviously appropriate for everybody, because it's another expense during a constrained period of time, but the benefits may outweigh the cost. What do you think about that, Dennis?
I think that's a great option, right? As opposed to certainly having to impact payroll or even accounts payable, having that ability, for a line of credit or additional advances, I think is an excellent way to address a short-term cash flow situation.
It's actually funny. I literally just had a conversation yesterday with a company in the staffing industry. I'm like, well, hey, you interested in at least having a conversation? And he's like, well, our current lender will lend against all of our receivables, so we're in good shape. It's like, that's not what I'm calling about. I'm actually asking, what is your current advance rate? He's like, well, it's 75, like you said. I'm like, what if you could increase that advance rate to 90%? Staffing is a very cash-intensive business. He's like, oh, and I sent him an email. I'm like, so just look at the straight math. You have $15 million in AR, for example. Your current advance rate is 75%, which is going to be this number. Increase it to 90% minus that incremental cost, which is $10,000, right, as an example. You have $1.5 million more in cash flow readily available, and that's just straight math. I'm like, listen, the ball's in your court, but you have more money at your disposal. So that conversation just happened yesterday. So not a plug or anything along those lines, but just something that can make sense if the math is there.
Yeah.
So anything else to add you guys can think of? Not to be trade credit insurance specific, but
No, I think we covered that topic.
Okay, cool. So once a business survives that short-term cash crisis, would you recommend just really build a stability-oriented cash flow model would be your best practice? Do you have any other tips?
Yeah, actually, it kind of goes beyond that cash flow forecast. So once you get into a position where you can look longer term, you're going to want to put a budget in place, right? And that budget includes an income statement, P&L, cash flow statement. Actually, I meant income statement, balance sheet, and cash flow statement. And we do that on a 12-month basis, right? An annual budget that allows the business to set targets and goals and objectives for them to achieve as we move that forward. And so now we've got basically a 12-month cash flow forecast as a result of that budget that's in place. We want to update that budget each and every month. We call that the forecast, right? So we're always rolling forward that forecast, that budget that we call a forecast every month. And it actually then, leads into the next budget cycle. So after a year, you really assess and see where you've met the goals and where you haven't met the goals. But you've got that forecast that's been, from the last month of that year. So your budget is practically done if you've kept up on it, but it's time to relook at the longer term, the 1 year, the 3 year, and the 5 year, kind of goals that you have in mind, and then updating the budget for the following year in that way. So once you get to that point, you've kind of got a nice operating rhythm and cadence where you've always got cash flow being looked at, 1 year out, and addressing all the issues you have with, buying capital equipment, hiring new people to kind of address growth in the business, and any other different, kind of cash inflows and outflows that you have, you want to bake into that scenario. And the forecast allows you to adjust them as you go along because, there's always variances to the budgets and the plans that you put in place.
I would say the one thing from all three of us speaking, certainty and stability is the number one thing we all stress, because the business world, there's always uncertainty, but who can predict? Let's talk about the tariffs. Who would have thought tariffs would have came into play to the rate that they are in right now? Because maybe different next week for all we know, right? Mm-hmm. So planning future dating your business is critical, and having a structure with trusted advisors like us is critical, in my opinion.
Yeah, and I get surprised how often I run into not just business owners, but financial people who'll tell me they don't need a budget. And I always say, what world are you living in? Because, maybe in a static world that'll work, but in the world that, I see every day, and in the world of, what you're describing,
yeah,
you need those tools to kind of help you look forward and see what's going to happen.
how many of us have never set a personal budget? I mean, let's think about it from that standpoint as well. Just if you never set a personal budget, what do you spend your money on? It's just, I can speak for personal experience. When I was younger, it's 60% of my expenses were at restaurants and everything like that, all discretionary spending. So, just kind of funny to think about it from that standpoint as well. Without a budget, where's your cash going?
Yeah, I mean, I think that's a great point on both the personal context and the business context, right? I mean, if there's certainty in cash flow, right, then that's where it makes it easy for a bank, or easier for a bank, to provide financing, right? So when a bank underwrites credit risk or the extension of credit, what we're really looking at is the current period and the three periods that happened prior to that, and saying, hey, if we had this level of debt or credit extended, could they have met the obligations? So it's not really a super complex exercise, but it's an incredibly important one, because let's just say on that 4-year look back, right, a company can only cover the debt or the leverage one of those 4 years. We're probably not going to make the loan, right? So the certainty of cash flow and putting a cadence in place to budget and deliver upon that budget allows it and makes it much easier for the bank to extend credit for the company to grow its business.
Yeah, I mean, that's a great point, especially speaking from your experience. The certainty is ever critical, because the one thing anyone wants is stability and flexibility, and cash is the best way to do that.
So I have a question for you guys. So in the time we're at now, where there's a lot of uncertainty, economic uncertainty in the market.
There is? What are you talking about?
So how does that affect, how you look at the world, how you do business?
I'll let Scott speak first.
Yeah, so I mean, it really goes back to what we've been talking about this entire time, right? Which is, if you have a company that knows, I'll say it very simplistically, they know how to execute the business plan, and they've proven the ability to do it in a diverse set of circumstances, those are people who it's super easy to lend to, and who any bank would want as their customer, right? So that's the thing that we look for, right? Like, how do we find those type of customers and business owners that can operate at that, I'll call it, top decile level of performance, right? But not everyone does that. So then the next thing is to evaluate, what are the other aspects of that company that make them bankable? And then that's where the analysis and the conversation could take a lot of different twists and turns. But if a company really shows the ability to consistently perform at that high level, it really makes it easy for us, despite whatever noise and market turbulence is coming their way.
Yeah, so I would say, to echo Scott's comments, my favorite clients to work with are the ones that are super, super tight on their credit that they work in. They keep track of their AR really tightly. They make sure they get paid as fast as possible. Their day sales outstanding, their DSO. So they're really tight on their credits. They're the best type of customer to work with, because they know if they take $100K loss, or like they have a credit line of AR that's $150,000, if that gets paid late, or if that's never paid, it's going to put them in a bit of a bind. And they know that, and they can justify the additional work. And they know they have a resource with my company that's going to give them unmatched credit intel, and they can justify the expense because they can sell more knowing they have a partner that pairs up well with their due diligence process. I think anyone who says our system is great, our system is fine, it's only fine until you look at additional resources that are available, like what we do. We had to be too late to the game before we come into play.
Yeah.
So thank you for asking that question.
Dennis, I'm interested, like, what else? We obviously focused the conversation on cash flow and optimizing, that aspect of the business. But like, what are some of the other things that your clients frequently engage, a focused CFO for assisting with it within their business?
So generally, it's a smaller business. In a lot of cases, they don't know. They just know that they're not financial people and they're in some kind of financial distress or financial pain. So, we probably see cash flow being the issue, most commonly. And then after that, it could be, the pricing that's been set up isn't correct, doesn't take into account all the different factors. And, you get in a situation that the more they sell, the more they lose. And that's not sustainable, right? So that's a short-term situation that needs to be fixed and addressed for the business to be able to go on. In a lot of cases, they're looking at a growth scenario. They've never used outside capital before, and they'll bring us in to kind of support that process of working with lenders like yourself to provide the information that's needed. Because again, in a lot of these businesses, that information doesn't exist in a form that the banking community would want or accept. And so we'll kind of help them in that regard. Those are probably the primary ones, but there's almost every engagement is a little different in terms of what's going on within the client and what the issues are. Sometimes it is, you've got owners that are, paying themselves and supporting, resources that don't necessarily relate to the business, but they put a drain on the business because they're being kind of, financed and used through the business. And so sometimes you have to look at that and kind of restate things to provide a meaningful financial statements that take those things into account and kind of normalize the results versus, other businesses in that same industry.
I was just tracking, obviously I track bankruptcies in my role because we would take care of that for the clients. And many times I'm like, hey, I saw you were affected by this bankruptcy. And like, do you have any business with this company that filed Chapter 11 bankruptcy? Obviously, you're not ceasing operations, but you're restructuring. So you need to be aware of that. And when I see the Schedule Fs that come out and where the assets are allocated, the personal expenditures on like a yacht or like these designer cars, it's just wild. So, cause it's one thing we talk about personal finances, I'm cash rich right now. And if you're a well-run company, which we all prefer to work with as best clients, that shouldn't be an issue, but it's a very real issue. So I suppose I'll close this, with a recap of just some of the things we talked about. The biggest thing is the importance of a cash forecast, the importance of having flexibility as far as bringing in experts like us, and then really just structure and stability. That's the number one thing I think is big. Is there anything else you can think of in the conversations?
Yeah, and I would say kind of longer term, having a budget, having a forecast, having a financial plan and a strategic plan that looks out, 1, 2, and 3 years, are also kind of key elements for any business to have, regardless of size.
Yeah. Anything you want to add, Scott?
I agree with Dennis wholeheartedly. I mean, the number one reason companies ultimately fail is they run out of money, right? That's the number one reason any company fails is they run out of money. So the liquidity issue, the access to cash, knowing where your cash is, and frankly, knowing where it's going are critical components that it doesn't matter if you're a $500,000 business or a $50 million business, the importance is just the same. So I think that Dennis brings a valuable skill set with his cash flow discipline to companies of a variety of sizes.
And I do think 35 years of experience running companies, both as a CEO and CFO, have a great point of leverage that you can reference to bring in the expertise. My closing last comment is it's March 11th here of 2025. What's the biggest alert or watch out thing right after tariffs have been announced and things like that every business should be watching out for right now, in your opinion, whether it be merchant cash advances, some predatory lending, or things like that you can think of within your client bases that everyone should watch out for?
I think at the present moment, it's kind of the uncertainty around, tariffs and just the changes that are happening kind of out in the world today, right? And the implication those are going to have on all industry and businesses, and kind of being in tune with that, because I don't care how good of a budgeter or forecaster you are. Those things are kind of, fresh and new right now, and you need to be able to kind of react to those things as they come up. And so those are challenges that are difficult because we can't foresee them too far in advance, right? These are very, very, kind of timely issues that are coming up and changing. And so how you're going to react to those, I think, is really the primary challenge I see out there right now. Scott?
So I think the main thing is I'm seeing softness in certain sects of the manufacturing space right now. I think we're all seeing that in various industries and that, but I know of a couple different companies where sales have fallen off, and those sales that have been lost have created a cash flow crunch, and in some cases negative cash flow once they're considering servicing their debt obligations. And it can create a difficult work environment for those companies to navigate through that. So I think one of the risks, Matt, to answer your question of what are the things that companies and senior leaders should be focused on, is they really need to keep an eye on their sales and look for any softness, and not just look at it from a cavalier standpoint, but they should look at it from the standpoint of this, there's something here we need to investigate. We need to find out what's going on, because if those sales fall off too fast without appropriate actions taken on the expense side of the P&L, it can cause a world of hurt in very short duration.
Especially in manufacturing, so often I have conversations with businesses, and I've been doing business with them for 30 years. They always pay me. I don't have a concern. I say this all the time, but I take them to our underwriters, which the advanced data that we have, and we won't support that credit limit because of what we see from a liquidity standpoint and predictive analytics, things like that. Hey, we're still going to support you with that business, but that's way too risky of an endeavor given the credit. Let's say an example, like you sell $500,000 on the credit line every 60 days. And then we won't support that because what we see from them, from their financials. And then, of course, if that business were to take a $500,000 loss over that 60-day period, that's a pretty significant hit. So,
yeah, for sure.
That's very real in the manufacturing sector because margins continue to drive down, and the international dynamic is a big factor right now with tariffs and retaliatory and things like that. So, that's all I have at the moment. I thank you everybody for joining us today. You'll see everybody's LinkedIn profile. Please reach out if we can help you with any of these topics, and looking forward to seeing you here out in the market.
All right. Thanks, Scott and Matt. Appreciate being here.
Thanks so much, Dennis.
All right. Thank you, Dennis.